I'm Charlotte McLeod with the Investing News Network, and here today with me is Nick Hodge, editor of Daily Profit Cycle. Thank you so much for joining me. Always great to see you.
It's a pleasure. Good to be here in Vancouver.
Yeah, so we are here in Vancouver. We're at VRIC. And of course, as usual, I'm going to start by asking you about your presentation title because you always put together such interesting ones. This time we have a great alliteration, money and mouth, where I'm putting them, a mid-cycle commodity update. So let's start with that. Where are you putting your money right now?
I think you have to break it out by risk level. The services I publish are based on that, the level of risk you're willing to take and sort of the goals of your money. So if we're talking about, long duration, less speculative capital, I still have a lot of cash. I think that we're still in for a bear market in the broader indices like the S&P. And that would be my largest allocation in like a retirement account. After that, I own gold, both in its physical form through a trust and then some large gold miners, producers and royalty companies. That's what I talked about in the talk on the safe side of the spectrum, and also larger uranium equities, I should say, ETFs. So you really get a broad-based allocation or exposure to the producers and some of the explorers, and actually some uranium pounds if you buy like the Sprott uranium ETF, for example. And then non-resource, I guess, quickly, because we want to talk mostly about resources, but some sectors of the S&P are okay, like consumer staples and traditionally defensive sectors like utilities. We've been buying those. But on the whole, stepping back and looking at the macro picture, I think we're still in a bear market. I think that interest rates are going to continue to go up for the next couple of quarters, and that volatility you can use to get into some more speculative positions, which is what I talked about on the sort of the second half, or the more speculative allocations, if you'd like to hear about those.
Yeah, I think we'll get into definitely all of those things. The other thing I want to ask about the title is mid-cycle. So what do you mean by mid-cycle? Can you explain that a little bit?
Absolutely, yeah. So I think we're in the middle of a commodity supercycle that began in 2020. If you take a step back and look at the CRB Commodities Index, its last supercycle began in the early 1990s, around 1994. Ran all the way until 2008, when of course we had the global financial crisis, and then that CRB Commodities Index retraced all the way back down to its base. And it kicked off again in 2020, spurred by lots of stimulus, lots of money in the system, and some macro trends like electrification and decarbonization that allowed the entire commodities complex, including softs like wheat and lean hogs and coffee, to really start accelerating in 2020. So we've been in the cycle for about 2.5 years now, something like that. And so maybe not quite mid-cycle, but in the cycle. And there's going to be pullbacks. If you look at the previous cycle that I mentioned that started in the early 1990s, there were significant ebbs and flows, multiple opportunities to get in, multiple opportunities to sell. Trees don't go to the sky, the commodities don't go straight up. And then it was sort of a double meaning for mid-cycle. I think that we're also going to have another recession. In the United States, we had sort of a mini one last year. We had 2 consecutive quarters of negative growth. Everyone was arguing whether or not that's a recession, and it was. But it was short, and in Q3 and Q4, GDP went back to positive. I think you're going to see that go back to negative here in early 2022. Going to create some volatility in the market. And like I say, you can use that volatility to get in some longer term commodity positions. I've been calling it, and this is a technical term, a double whammy recession. So we had a small one last year. Growth went back a little bit. Stocks are doing okay now, but I think we get another period of recession, volatility, and bear market.
And to be clear, so last year we had, as you said, that little mini recession. The one that is coming, that would not be a mini one.
Well, I think it'll be larger and more pronounced. There'll be less arguing about whether or not it is a recession, because I think it's going to come with higher unemployment, which we haven't seen yet. So, the trajectory of a recession is, it affects housing, and then it affects orders. We've seen that, housing prices coming down when interest rates are going up. We've seen orders be affected if you look at like ISM manufacturing, purchase order surveys, things like that. And then it affects profits, which we're seeing now. The S&P is going to have negative earnings growth for this quarter. The numbers we're seeing this quarter, which are from Q4 2022. And then it affects employment last, and we're starting to see that now, at least in the tech space, with some high-profile layoffs announced by Amazon and Meta and Microsoft, for example. So I think you'll see unemployment tick up, and that there'll be no denying that we're in a recession. I'm not sure it's going to last. I don't think it's going to be a depression. I don't think it's going to be a year or two thing. I think it's going to be enough to give the Fed room to cover, and then they'll stop raising rates and potentially even cut rates late in 2023 or early 2024. And I think then we'll have a really strong bull market.
Okay, and so let's work through some of the commodities that you mentioned just
Sure.
at the start of this talk. So first you were talking about gold, right? So I think people are having some interesting thoughts about gold, at least here at this conference. Definitely we've seen it gone up over the last really 3 months or so, which is around the last time we talked. We were speaking when the gold price was quite a bit lower than it is right now. But people right now seem to be thinking, wow, what happens now? It's up, but we don't really trust this necessarily.
Yeah, I think that's a fair assessment. Gold was relatively weak last year in an environment where it should have been much stronger, an inflationary environment. And we saw gold, it eked out a small gain for the year. It didn't go down, but it didn't perform like people were expecting. That was primarily attributable to a very strong dollar that we had last year that has softened a little bit in the past couple of months. Gold really started going up, as you say, since the last time we talked, late October, early November. And that's a function of the longer term bond yields coming down. So follow me on this journey for a second. We've got an inverted yield curve. That means the 10-year yield minus the 2-year yield is negative. That says we're heading into a recession. The reason it went negative last year was because the 2-year was rising very fast. That's because the Fed was raising rates. They control the short end of the curve, the 2-year. Now the 2-year isn't going up as fast. The 10-year is falling. So you got the 2-year up here, the 10-year is falling, and that's creating more inversion. And that softening of the 10-year is what's allowed gold to go up. If you look at a chart, it stopped. The 10-year yield stopped going up in October, early November. It started going down, and that's when gold started going up. So gold, what I'm saying there is taking its cues not from the dollar anymore, but from bond yields, and that's very bullish. Especially if we do get the recession and bear market that I was just outlining a couple of seconds ago, because you can see a capital rotation where people are finally convinced that the S&P is in a bear market and they need to allocate to something that's going up, which could be gold. It could finally get its fear tailwind. That's a pretty good assessment on gold. It's technically bullish right now. If you look at a chart, it broke through 1800 very nicely, broke through resistance at the $1,920 level, and we'll probably start banging on the $2,000 door fairly soon over the next couple of months. Not to say it's going to break through that door, but it could shy away. But nonetheless, that's $300 higher than it's been in the past couple of months.
Yeah, and that does feel, relatively close. We'll see how it goes. But that's a really interesting look at what's going on with gold, because definitely, especially here, I am still hearing that whole gold connection to the dollar argument, and I don't know that too many people are looking at it as you are.
Yeah, I try to be contrarian.
Okay. So, and maybe we could talk just briefly about how silver is fitting in there. Do you see silver going along with gold? Is it going to instead go in a different direction?
Yeah, I've become a little disenfranchised with silver in recent years, specifically because people are always calling for it to go to the moon. I think you and I might have talked about that. And we've seen that it hasn't performed as well as gold has. It's at $24. It takes its cues more from the industrial side of things, because it is more of an industrial commodity as opposed to a pure currency like gold. And what I was saying in my talk is that those fear tailwinds that could propel gold higher could be headwinds for the coppers of the world, and silver is included. If gold does break out into a true, rip-roaring gold bull market above 2,000, silver is going to go with it for sure. It always does. I just simply like gold better.
That's fair. That's fair. So if we move on now to uranium, this is a favorite topic of our audience, but I can tell you that recently I think people, similar to gold after 2022, when everybody was a little bit disappointed that it was flat instead of up, I think with uranium there's also that sense that, well, it should be higher. What are your thoughts on uranium right now? Where do you see us in that cycle?
I think you had a really strong run in uranium and uranium stocks in early 2022 that sucked people in. Started buying earlier in the year, and then, as you say, it fell off in the second half of the year. We got up to mid-50s or $60 a pound, and then pulled back down below 50. And that's what bull markets do. It's consolidating higher, which is a good thing, and it shakes people out, which is also a good thing. Should the uranium price be higher? It needs to be to incent production to come online, but at the same time, the market is never wrong. That said, the fundamentals for uranium have never been stronger. We're done talking about things like is Japan going to restart? Are the utilities going to come back in? The answers to those questions have now been given. Yes, Japan is going to restart. Germany's going to keep their reactors running. The utilities are coming back into contract. But even more than that, there's more bullish catalysts now that we haven't been talking about in the past couple of years. We're getting small modular reactors approved now. We're getting hundreds of millions of dollars from the U.S. government to procure low enriched uranium. They're buying uranium directly from some of the U.S. producers. We've realized that we have a problem with the supply chain as it relates to Russia, not just the supply of uranium, but the enrichment and conversion of uranium as well. And that's actually a big topic. So one thing that's switching now is underfeeding and overfeeding. I don't know if anybody's talked about that, but you used to be able to put in less uranium and get out as much as you needed or more. You could squeeze more juice from it. As that conversion and enrichment moves to Western nations because of the Russia situation, we have to overfeed, which means you have to put in more uranium to get the same amount out. So that's increasing the demand side of things. At the same time, you have other sources of demand that aren't just nuclear reactors. You have companies now buying uranium pounds, the UECs of the world, the yellow cakes of the world. And even the trusts, like the Sprott Uranium Trust, that are adding to that demand picture. So demand is continuing to go up. Reactors are staying online longer. That's another main point. People are realizing that it is an answer to the climate situation, to the decarbonization. And then you had like Kazatomprom just last week, for example, announced that they're cutting supply. So you're in a very precarious supply-demand situation where mines are going to produce something like 110 to 120 million pounds of uranium this year, and we need like 190 pounds. And used to be able to make that up on the secondary market via the underfeeding and overfeeding that I was just explaining, and that doesn't exist anymore either. So things are getting very bullish for uranium. I think it's a very high-quality long-term buy, and I've been telling my readers as much. We own it on multiple levels. I mentioned the ETFs earlier, but we make speculations in explorers and uranium prospect generators as well.
So, the list is really long, as you've just outlined, of all these positive factors that are good for uranium, they're good for the nuclear energy industry. Is there anything that can knock us off this path that we are on?
They're getting fewer and fewer, right? It used to be, is sentiment going to change? You've got now, the Greta Thunbergs of the world saying, we should be embracing nuclear more and protesting coal, for example. The biggest thing is some sort of disaster, which has to be mentioned, which always, diverts the sentiment of the uranium industry. Nonetheless, we know that nuclear energy is the safest, cheapest form of power that humans have ever conquered. So I don't see that on the horizon. It just has to be mentioned as a risk when investing in the space. But it's being embraced. It's being embraced by Democrats in the United States. They're extending the life of reactors in California. It's being embraced by the European Union. It's being embraced by global leaders. They just had the World Economic Forum in Davos last week, and they screened a film by Oliver Stone called Nuclear. So, right. So it's being embraced by the global community. That's sort of a signal, like, hey, everybody, it's time nuclear is not so bad. It's not the boogeyman. We're going to need this to meet our climate targets.
Right, and so I know you have another uranium panel coming up this afternoon. I believe it's this afternoon. And it's about how to make money, but also how to keep that money, which I'm assuming refers to, you have to know when it's time to exit. So I want to talk about that a little bit, because I think that might be hard for people. Getting in is a little easier, and when to leave is not.
Yes, well, when you're satisfied with your gain is the easiest answer I can give. But when it gets really fervent, this is like the Shoeshine Boys story, right? When everybody's talking about uranium, when it's in a fervor, reaching a fever pitch, when the Twitter sphere is going berserk, hashtagging to the moon and things like that. That's a wonderful opportunity to sell. And we did some selling last year of uranium stocks and have subsequently bought back in. They can be wonderful to trade in that respect, although there's no concrete way to say now is time to take profits. They're not going any higher. It's a sentiment game, I would say.
Okay. And so that gives us a good look at what's going on with uranium. I think another topic I want to touch on is copper, because we talked about it in the tail end of that last interview when we were speaking about what commodity might appreciate the most over the next 5 years. And you threw out copper, and we didn't have too much time then to go into it, but now we do. So recession and copper, I'm curious about how that affects copper, and then also how China's reopening plays into that. So what are your thoughts there?
Well, I think you laid it out kind of well there. The copper has gone up. It was $5 last year, fell back down below $4. In the past couple of months has been going higher, likely attributable to the reopening of China. I think that the headwinds I outlined earlier, the recessionary headwinds, the bear market and broader indices, will give some volatility to copper over the next 2 quarters, 6 months. And that's what I was saying in my talk. Use that volatility to enter positions. I don't know if copper goes to $6 this year, but I think that copper certainly goes to $6, $7, $8 over the next 5 years. It's one of the keystones of the global decarbonization movement, and people don't realize it's as constrained as some of these other commodities we talk about. I mean, lots of production comes out of South America. There's significant political issues now, particularly in Peru. And the processing is another pinch point. I think China processes like over 80% of the copper, similar to, not as dire as rare earths, but certainly they dominate the copper production. And sources that can come online in North America, I think are going to be very beneficial to not only the global supply chain, but to investors as well.
Yeah, and I think one of the themes I'm taking away from this event is, there are things we should look at right now and things that are going to be good later. And copper sounds like maybe that's kind of one of them. And maybe that goes back to also your idea about commodities supercycle, where we've got momentum for everything. Does that kind of make sense?
Yes, yeah. I mean, all commodities don't go up at the same time. So, yes, if you think back to 2021 and 2022, when inflation was transitory, right, which it wasn't, all the commodities were going up. There was, lumber at record prices, wheat, doubling or tripling, corn tripling, all these soybeans, coffee were going up. And now we're seeing a divergence in that. And that's the ebbs and flows of the commodity supercycle. You're getting a consolidation of the CRB commodity index now, particularly because those soft commodities are consolidating, the ones that are dictated more by supply and demand, and particularly demand destruction fears because of a recession. The other thing that's happened is oil has come down significantly. I mean, last year that was a big driver of commodities higher. Oil went negative, if you remember, during the pandemic, and then it went all the way to $120 in very short order, and has been pulling back to 80 or 75 where it is today. I haven't looked. And that's what gives you those ebbs and flows. I think there's 19 commodities in that CRB commodity index, and they don't all go up and down at the same time, particularly in this environment that we're having with a Fed tightening cycle and a recession upon us. And then there's commodities that aren't included in that index, and that was sort of the final point I made in the talk, that are quasi, recession immune. Because they do have such incentives behind them. We already talked about uranium. Another one would be lithium. I mean, there's a fundamental shortage of lithium. We're going to be short again this year. Global supply of lithium is going to grow 42%, and that's still not going to be enough to meet the demand. And then some of the bigger producers like Albemarle, for example, came out with guidance last week saying that in 2030, which is only 7 years from now, there's going to be an 800,000 ton per year shortfall. To put that in context, that's how much lithium we're going to produce this year. So in 7 years, we're going to be short the entire global supply from this year. So. And there's mandates behind that, right? There's incentives from the Inflation Reduction Act. There's countries committing to banning the sale of internal combustion engines, for example. And so that demand is there simply because the global automaker fleet has decided to convert.
And just because I hear this come up from time to time when it comes to lithium and other metals used in electric car batteries, should we be worried about people buying less during a recession? Maybe they don't have money for those cars and things like that. Or is that, a short-term thing in this long term?
I think it's a short-term thing in this very long-term mega trend, as it were. Look, all these automakers have announced, from obviously Tesla, but Ford's converting, GM's converting, and they're finding it very tough to procure the supplies that they need. I think Elon Musk said on a conference call last year that processing lithium was essentially a license to print money. You can't lose, and those are his words, not mine. And now you've got a lot of gigafactory announcements. You see lots of announcements of companies that are committing to build these battery plants, and they're struggling to find where the input's going to come from. It's almost like they didn't think about it. Like, let's build this whole thing. Let's commit to all these targets. Let's announce all these battery factories, and oh yeah, we're going to need some lithium to make these batteries. And now they're going all the way to the miners. I mean, if you talk to some of these junior miners down here on the floor, I mean, they've got CA's confidentiality agreements signed with, big auto manufacturers, because they're sniffing all the way to the very bottom of the supply chain to see where the stuff is going to come from, because there's a dire shortage.
Okay, and one more, hopefully small question on not thinking things through enough. So the world is really committed to this green energy transition, right? But it seems like certain governments, people in the world think that we're going to get there faster than we really are, and it seems like we're going to need things like coal and oil and gas for a long time. Has that been thought through enough?
I mean,
and how do you get exposure to that as an investor?
I mean, global oil demand is going to go up this year, for example. I mean, look at the carbon intensity of the things they use to generate electricity in Germany. The carbon intensity has been going up, not down, because they've had to burn lignite and they've had to burn coal. And so that stuff is going to be with us for a long time. It never happens as fast as you think. I mean, I've been around for a decent amount of time now. I wrote a book about investing in renewable energy back in 2008 or 9, I think it was. And none of those targets that were, being proposed then have been met. And I don't think many of the targets that are being proposed now are going to be met. People don't understand the fundamental nature of the supply chain that goes into those things, whether it's the commodities we've already talked about, or it's, rare earths, things that we haven't talked about. And they don't understand how long it takes to bring a mine online. I'll give you an example. I'm involved in a company in Idaho that has a critical metal that's been in permitting since 2016. I was telling the former CEO yesterday, I was like, hey, you started permitting when I had my first daughter, and she's going to be 7 years old this year. And the project has not been approved yet, despite the fact that this critical metal that they have is the only source in the United States, and the U.S. military has flat out said that they need it. And so the world, the government, certainly, lawmakers, definitely, just they don't understand the mining cycles.
Okay, I think that gives us hopefully a pretty good idea of what you're thinking right now about the resource sector. Any final thoughts you would leave people with in 2023?
Uranium and lithium, I think, are going to be really hot sectors early on. And then, use the volatility that's coming, because the bear market's not over. You're going to get some chances to buy quality long-term copper plays and even gold plays for the long term.
Okay, well, we'll wrap it up there. Thank you so much for coming on to talk as usual. Great to hear from you.
Great to be here. Thank you.
Okay, and once again, I'm Charlotte McLeod with the Investing News Network, and this is Nick Hodge with Daily Profit Cycle.